Welcome to Capital Link's company presentation series.
Good day to everyone. I'm Nicholas Borneos of Capital Link, and I would like to welcome you to Capital Link's company presentation series. We have with us today the senior management of Euroseas, Mr. Aristides Pittas, Chairman and CEO, and Dr. Anastasios Aslidis, Chief Financial Officer. A quick mention of a disclaimer that this presentation is for informational purposes only. It is not meant to be investment advice or advice of any kind, and it is not meant to be solicitation to transact in any securities. In terms of the logistics, we start with a brief company presentation followed by a live Q&A session. Please submit your questions during the session anytime using the Q&A button at the bottom of your screen, and your questions will be answered by management after the slide presentation. And in closing, this session will be available for replay upon demand very shortly after the live session. So thank you very much to everybody. I turn the floor over to Mr. Pittas, Chairman and CEO. Thank you.
Thank you, Nicholas, for this introduction. I am very happy to be here to present our company today. The job that you're doing with these nice brief interviews is really useful, I think, to the industry as a whole. So today, Anastasios Aslidis, our CFO, will be making the presentation, and then we will answer the questions that you will have sent us and hope to give you as much clarity as we can on what's going to happen in the future. So Tasso, without further ado, please get on with the presentation.
Thank you very much, Aristides. Thank you, Nicholas, and let me add my thanks also to Capital Link for organizing this series and inviting us to participate. Before we start, I would like for a brief moment to draw your attention to this slide, which states that we will be making in this presentation forward-looking statements within the meaning of federal securities laws. Please bear that in mind as we go through the rest of our discussion. I will start giving you a very brief overview of how we started. I believe most of you know that already, but for completeness of our presentation, I would like to introduce Euroseas again. Euroseas is a provider of worldwide ocean-going transportation services. We provide services for the containerized trade. The company was established by Aristides and his family 18 years ago. Aristides and his family have been involved in shipping for ages. Clearly, their family's history spans 3 centuries. We have records of them being involved in shipping since 1870. Euroseas has a fleet of 17 vessels on the water, 10 feeder ships and 7 intermediate container ships, with a cargo capacity of about 53,000 20-foot equivalent units, or TEUs, and also has a 9-vessel new building program with deliveries scheduled to be this year and 2024. And after the delivery of these vessels, our total carrying capacity will increase to 75,000 TEU about. We pride ourselves for our long involvement in shipping and experience in ship owning and ship management. As I mentioned, we accessed the capital markets in 2005 and listed on NASDAQ in 2007. Aristides and myself, who might be called veterans of the industry, we have more than 30 years experience in the sector. Our Chief Administrative Officer, Simos Pariaros, has also more than 20 years experience in shipping, and we all have been with the company since inception. Also, the members of our board, all the members of our board hold leading positions. Not only they hold leading positions in their respective industries, but they have long investment experience in shipping. We manage our vessels through Eurobulk, an affiliated company, was established in 1995 by Aristides and is a player and a manager well respected in the industry for its efficient and safe operating track record. We consider our group to be vertically integrated. We provide services along the entire range of ship management, and we have developed strong relationships with charterers, suppliers, bankers, and other industry players. Having made that quick introduction of Euroseas, let's talk first about the sector, about the container ship sector. And let's start doing that by taking a snapshot at where we stand in terms of rates and prices. This slide, slide 6, shows on the left side the development of container charter rates over the last 20 years, and on the right side, the same thing for 10-year-old vessel prices. What is striking from these charts is that in the last 2 years, we registered all-time highs for both rates and prices. Previously to that, the highest levels in the industry were observed almost 20 years ago during 2004 and 2005. And after that, after the financial crisis, there is a long period from 2011 to 2020 of about 10 years of pretty miserable, should I say, level of rates. The pandemic, to some extent surprisingly, but easily explainable, provided the point where a new level has been registered for rates and prices. A combination of changing demand patterns and preferences and the supply situation from a tight supply created that significant spike in the sector. Starting at the end of last year, in the fall of 2022, we've seen the markets correcting heavily, the same pace as they increased, and we're now at rates that are above pre-pandemic levels, but having come close to that levels. Clearly, rates are formed by the interaction of two forces in the market, supply and demand, and we'll take the next 3 or 4 slides to talk in a little more detail about the trends that are emerging on those two components. Let's start with demand. This slide here, slide 7, shows the world economic growth on the top line and tries to correlate it with the containerized trade growth. If you plot those two lines, and you can see the chart at the bottom of the slide, at least visually, there is a pretty strong correlation between the world economic growth and the level of the containerized trade. In 2022, we've seen world economic growth to drop to 3.2%, according to IMF, as compared to 2021, with the containerized trade growth reacting even more aggressively downwards. We expect to register, according to Clarksons, a 5% decline in containerized trade. In 2023, Clarkson expects little change in containerized trade, about negative 0.3%, essentially flat, while we expect to see containerized trade increase again in 2024. That's the half of the equation, the demand side. Let's look now at the supply side. This slide takes a snapshot of the current container fleet situation. At the bottom of the slide, we show the order book of the fleet as a percentage of the fleet. You can notice here that just before the pandemic started, the order book as a percent of the fleet was at its lowest level ever, creating a tight supply situation. During the high rates of the pandemic, owners started ordering again, driving the order book to fleet ratio to a very respectable and quite high 28.3% of the fleet. Typically, order books are delivered over the next 2 to 3 years, and that means that, and you can see that on the top right part of the slide, that the expected deliveries in 2023 and 2024 are between 9 and 10% of the fleet. Imagine about 0% demand growth against a 10% potential increase of the fleet, how much more pressure on the rates it could exert. The fleet might not grow 10%, might grow less because certain ships might find it uneconomical to continue operating in such an environment. And there comes in play the age profile of the fleet that we saw on the top left part of the slide here. It's a rather young fleet, although still there is a good 10% of the fleet that is above 20 years of age. And these vessels are prime candidates for potential removal if at the end of their current charter, they find economic conditions that are not worth continue operating. In addition to the pure economics, there is environmentally related regulation that comes into play this year that could affect the decision about continuing to operate or not. We'll talk a little bit about this a little later. Another point that one should make on looking at this slide is if you look at the 20-plus-year-old chunk of the fleet, segment of the fleet, the majority of that are vessels in the lower size groups, the feeders and the intermediates, the two vessels that our fleet primarily operates. Thus, it is worth digging a little bit into further detail in the smaller segments of the fleet, and this is what we'll do in the next couple of slides. First, the feeder sector of the fleet, the vessels between 1,000 and 3,000 TEU. This is the segment in which our new buildings belong. You can see here that although the entire fleet has an order book of about 28%, this segment has an order book of about 15%. In addition, the percentage of the fleet that is more than 20 years of age is 25%. The fleet is more evenly distributed age-wise here. And that it is very likely that segment of the fleet not to grow as much, potentially not to grow at all, if the majority of the 20-plus-year-old vessels find it uneconomical to continue operating, thus providing a little better supply trend for this subsegment. Something similar is true for what we call intermediate vessels, the 3,000 to 6,000 TEU vessels. We have 6 vessels operating, almost 7 vessels operating in this sector, almost 7 because the other one is 6,500 TEU. Here, the order book is even smaller, it's only 6.7% of the fleet. And again, there is a good chunk of vessels that are more than 20 years of age. So that segment of the fleet too might face very limited supply growth and potentially no supply growth. It is undeniable, though, that the overall picture is shaped by the relatively big order book for the larger vessels. And those vessels moving down into trades currently served by feeders and intermediates might be a trend that we need to keep an eye on. Supply is affected not only by the number of ships that are out, but also by what those ships are doing and whether they are tied up in non-productive activities. This slide here shows an attempt to measure the port congestion. And the more ships are tied up in ports, obviously the less ships are available for trade, and that creates increases in charter rates. We can see in this slide the percent of ships tied up in ports across various shipping segments. Containers is the light blue line, the top line for most of the chart. We have seen that the congestion index of container ships hit a high of about 37% in the middle of last year, and has come down to close to 33% at the beginning of this year. This 4% decline of the fleet that is in port is 4% more fleet available to trade and carry cargo. So that is another factor that has contributed to rates declining so quickly in the last 4 months of 2022. And how that will develop obviously will affect the future availability of supply. Time to summarize our quick review of the segment. It is clear that 2022 has created 2 interesting points, an all-time high and also a significant drop. Political and economic insecurity affected container shipping in the latter part of the year, and freight rates dropped significantly. The reversal also of port congestion created effective more supply, and that contributed to, as we just mentioned. In 2023, market conditions are generally expected to soften even further. As we discussed, demand is expected to be flat, and we expect significant supply to hit the market. And rates thus are expected to continue to move towards their historical average levels and possibly even break them downwards. In 2024, there is a number of developments that are emerging, which are quite difficult to assess yet. For one thing, geopolitical developments like hopefully by then ending the war of Russia and Ukraine and its aftermath, and other global tensions will play a role, as well the overall economic conditions will affect demand for containerized trade. And in addition, as I say, a potential help for rates could be if new environmental regulations result in more slow steaming, effectively removing capacity from the market and moderating the impact of deliveries. One thing that seems to be emerging is that the difference of the eco vessels, and all our new buildings are eco and fuel efficient vessels, with an older ship, that spread between charter rates is expected to increase. Final point here, before we switch to review our own, the Euroseas position in the market, is that the smaller size vessels, where we operate between 1,000 and 6,000 TEU, are expected to perform relatively better because they have a healthier supply situation with much smaller order book and much older current fleet. I mean, without doubt, of course, cascading of larger vessels to trades currently served by the feeders and intermediate ships could mitigate any difference of supply demand between that sector and the larger vessels. Having talked and characterized the market segment we operate, I think it's time to spend a little bit of time to review how Euroseas is positioned in that environment. A very quick look first at our fleet. This slide shows you our current fleet on the water, 17 vessels, 53,000 TEUs, 17.5 average age. And we have our new building vessels that will start being delivered in March this year and continue their deliveries throughout 2024. These are feeder vessels, 9 of them, total TEU 22,000 of capacity. 6 of them are 2,800 TEU vessels and 3 of them are 1,800 TEU vessels. Our fleet is chartered, and this slide shows the chartering profile of our fleet. We used the opportunities offered to us during the last 2 years to charter the majority of our fleet in long-term time charter rates. For 2023, for this year, more than 80% of our available days have secured our currently chartered at an average rate of more than $30,000 per day, contributing an EBITDA of 136 million. Even for 2024, more than 50% of our available days are chartered, again at a rate in excess of $32,000 per day. Amongst the vessels chartered are the first 2 of our new buildings with charters that extend even beyond 2025. Very quickly, we can review some of our financial highlights. For the first 9 months of last year that we have published results, I mean, those 9 months were very profitable. We had net revenues of almost $140 million, contributing earnings of more than $10, almost $11 per share on an adjusted basis for our shareholders. EBITDA for the 9 months was more than 90 million, and during the period, the average rate that our fleet earned was more than almost $33,000 per day. We have instituted in 2022 a quarterly dividend, and we have declared and paid 50 cents per share for each of the first 3 quarters of last year. 2023 starts from a rate level, as we saw, that is still above pre-pandemic levels, but clearly there are challenges ahead. Our own contract coverage, which, as I mentioned, is more than 70, more than 80% in 2023 and more than 50% in 2024, will largely shield our earnings from the current environment of low rates, and for sure will allow us to fund our dividend and the equity portion of our new building program. Of course, part of our new building program will be financed with debt. Looking forward, we expect to have a cash flow break-even level for the next 12 months of about $14,000 per day. And as I mentioned, for 2023, the contracted revenues are in excess of $30,000 per day, so we're well within cash generation range for 2023 and very likely for 2024. And if we look at our balance sheet, we can, the point we can make here that is so that we have very low debt compared to the value of our ships. We have about $108 million debt at the end of last year. This is debt for the existing ships, doesn't include our new buildings. We estimate the market value, charter adjusted value of our vessels, of our 17 vessels, at $330 million. So our debt to value ratio is about 33%. Even the scrap value of our existing fleet of 17 vessels is $130 million, and that is higher than our debt level. So we are very low leveraged. The light blue bar on the light blue section on the bar that you see here is the contract value of our new buildings, or the market value of our new building contracts, I should say. The contracted EBITDA in 2023 amounts to about $120 million, and that would likely increase if we charter the remaining open days for the year. Let me conclude our remarks here about the market and about Euroseas by providing some reasons why Euroseas is an interesting investment opportunity for you to look at. For one, we have insulated ourselves to a great degree from the current market by having secured long-term charters for the majority of our fleet. Each of the next 2 years are expected, based on the contracts we have secured, to be comparably profitable to 2022, and we're conservatively financed, as I mentioned, a fact that further minimizes any risks and increases our future funding flexibility. Our strategy is to grow the company and modernize it, and we're doing that organically, having embarked on a significant new building program with 9 vessels, modern eco-friendly vessels. Our new building program has a price tag of around $360 million. We're also continuously target selective acquisitions, especially ones that have fully covered downside, and we might be able to find more such opportunities if the market weakens. More important than that, or on the top of all that, we are rewarding our shareholders. Not only we have shielded the market and we are growing, we have instituted a dividend that provides approximately a 10% annualized yield, and in addition, we have established and executing on a share repurchase program when we believe our share price is a good investment for us. More than any of the above, we are an interesting opportunity to look at because our stock trades at a significant discount to our current NAV, more than 50% discount. It also trades at a significant discount to the value of our contracted earnings during the next 3 years and the scrap value of our existing fleet, even if we ignore the net value of our new building program and potential earnings from the open days of the fleet. I think for all these reasons, Euroseas is an interesting investment opportunity for our new investors and our shareholders to look and stay with. And with that, let me open the floor for questions and let Aristides lead that part of our presentation.
Thank you, Tasso, for the presentation. Let's jump directly into the various questions that we have. The first question is, how confident are we about being paid from the contracted charters, which should be above market right now? We are quite confident that the very big majority of our charterers will pay. We have fixed the majority of the ships with top class charterers, which have made a lot of money during the last couple of years, so are very strong. So I would think that all or nearly all of our charterers will perform during the next couple of years, because as Tassos correctly said, we have covered a lot of our ships for 2023, 2024, and even 2025 at rates that are higher than the market today. The second question is, congratulations so far, how safe is the dividend? Well, exactly because we have concluded all these charters, I think that for the remainder of 2023 and for 2024, the dividend is very safe. It yields about 10% on the current stock price, and I expect it to remain around those levels, except if we see fantastic opportunity and we need to jump in and not pay a dividend or whatever, but this is not the intention. Right now, only a fraction of our earnings is used to repay the dividends, so I think that the intention is to keep the dividend stable. The next question is, how much leverage is there on the new build vessels, and how does the price you paid for those vessels compare to current new building prices? Well, although second-hand prices have dropped tremendously, new building prices have not. And in fact, the cost of ordering a new build vessel today is very similar to the cost that we paid when we put the orders. And in fact, one cannot place orders for vessels delivered in 2023 and 2024 right now. So if somebody was to order, he would go for 2025, 2026 delivery. So we are confident that the price that we've secured is the current market price, and nobody can really order more ships at those prices today. So I'm not worried about the value within the ships that we've ordered. We have financed the first vessel, which we'll take delivery of in March this year, so in a couple of months' time. That is fully financed with 65% financing. We expect to easily finance with similar levels of financing the other vessels that are the other two vessels that are due for delivery in 2023, and we will probably be able to do the same in 2024. I feel very confident about that. 65% financing, and with the spreads around 2.5% maximum over SOFR. Next question is, again, the same one. Do you worry about financing the new buildings, about chartering them? I just talked about the financing of new buildings. It should not be any problem at all. Chartering them, again, I'm not worried about. Of course, I don't think I will be able to fix the new builds at the $48,000 per day that we have fixed for 3 years, the first two vessels. The market is not there right now. It has corrected tremendously. It's down to $25,000 per day for such a vessel per year. Still $25,000 per day, if we were to fix that, is a great level. It leaves a very, very significant profit. I remind you that the first two vessels we will repay them in totality in 3 years. So this seems to be a fantastic deal if everything goes as planned. Next question. Container freight prices are on the way down this year. Besides, container vessel charter prices are also on the way down. In this case, newly container vessel charters that have just entered into the sector can be negatively affected. Thanks in advance. I think I answered this question already. Indeed, current charter rates are much, much lower than where they were. But even today's levels are profitable levels, not as profitable as we saw during the last 2 years, where our stock price increased 10 times. I don't expect us to see such a return, but I do expect us to see a very stable market for our company during the next couple of years, stock-wise at least, and earning-wise. Final question I see now, there's a couple more who they keep on coming. How are the new builds being financed? Are there plans to sell vessels currently on the water to free up cash? There is absolutely no need to sell any vessel to finance the new builds. The cash flow generation from the existing ships is more than enough to finance the new buildings. In fact, there should be enough equity left there for us to continue both our dividend policy, our buyback program, and perhaps even buy an additional 1 or 2 vessels if we see very attractive prices developing within the next months. Who is your choice of technical manager and what are your views on OPEX inflation? Well, technical management is done by my family company, which has expertise in running these ships and has been running them for so many years, keeping OPEX well within the threshold of where the other shipping companies are, but at the same time being able to keep the vessels in tip-top condition, despite our old fleet being quite older. Of course, we are renewing the fleet these days, and the 9 new vessels will be the most modern in the small container sector around and the most economical ones, and we do expect to see the future based on more modern vessels. What is your plan for retiring your older ships? Again, most of the older ships have been fixed for long-term charters. The assumption is that at the end of the charters, when the ships will be over 20 years old, the ships that are over 20 years old will be scrapped. This is what we put in our models. It can only be better than that, not worse than that, depending on how the markets develop in 1 or 2 or 3 years when these charters expire. If they are good, we're going to pass them through a further special survey. But our main assumption in our model is that these vessels will be scrapped. Overall, you are a very different position from all other shipping companies operating out of Greece, even your webcast presentation. Are you also pure play in your webcasts over the past few years? Thanks. Well, thanks for the comments. I take that as a compliment. Thank you. Thank you. Next question, with new environmental regulations, what do you see as approximately the maximum age of ships before they must be scrapped? I think the maximum age continues to be somewhere between 20 and 25 years, based on the new regulations. Ships can trade up to that age. It continues to be more of a commercial consideration. If the markets are good, the ships can last a little bit longer. If the markets are bad, you're bound to scrap them earlier. And I think this was the last question, Tasso. I don't see any other questions.
I don't see any other question either.
Thank you all very, very much for being with us today and listening into our presentation. And as usual, we are happy to take any questions you might have individually or separately and try to answer them as honestly as we can. Thank you very much, guys, and good luck.
Thank you. Thank you from me as well. Thank you, Nico.
Thank you, Aristides and Tassos. Another great presentation. I'm glad
there's
that
one
we
more
had a
question,
very
Nico.
robust Q&A, indicative of the interest. So in closing, besides thanking everybody, I'd like to mention that this session will be available as an archive for replay and access upon demand. So thank you to everybody. Thank you.
Thank you, guys. Goodbye.
Bye.